Nigel is joining us from the newsroom floor. Guys, hi, good afternoon.
Hi. Afternoon. Already getting quiet. We're still far away, from Christmas and New Year.
The four of us or the market?
The market. Generally a little quiet and very range-bound today.
Well, go on, Nigel.
No, quiet is good, yeah. Perfect.
I think little too early, Nigel, to go quiet. Quiet to the end of the year. But it will get quieter, right? And I think global markets, etc., as we sort of... it's seasonally a good part of the year, absolutely. Last 2 weeks, last 3 weeks or so. But it also is a sort of quieter part of the year. And I think you will start to see that, not just here in India, but of course in the US as well. People sort of travel, all kinds of things. Just a few things before we get into the discussion. So the Nifty and the Nifty Bank, the last I checked, both, even with the cuts that we are trading with, are above their respective hourly averages, 40 hourly averages. For the Nifty, that level is 24,507. So it's about 40 points, 50 points above that. And of course, the Nifty Bank will come up in the corresponding level, which is the 40 hourly. And we are trading above the 40 hourly for the Nifty Bank as well. That's 52,690 on that one. So comfortably above the 40 hourly for the Nifty Bank. I think as long as that kind of holds, I think should be okay. Should be broadly okay. Broader markets are not seeing any big cracks or anything of that sort. That's the other marker you'd want to keep an eye out on. Small cap is flat, mid cap index is flat as well. Sectorally, IT, I think real estate, these are the two areas which are doing well. And I think the PSU space is a bit under pressure. I saw energy as a sector and CPSCs and generally, that entire pack is trading in the red right now. Rima.
Well, the small cap funds continue to get a lot of inflows. So even the November numbers show that the small cap funds have seen inflows which are 9% higher than the prior month, and the mid cap funds have seen about a 4.5% jump. So even as the overall net equity inflows have moderated by 14% month on month in November, small and mid caps continue to garner attention, and that pretty much explains the kind of up move that we've seen. I think the small cap index is up 5% since the beginning of December itself. By the way, a quick word on Europe, because Asia closed up with strength. You had the Kospi, which was up more than 2%. Nikkei was up 0.5%. Straits, China, these all managed to clock in gains. Hang Seng was the only one which saw profit booking after Monday's mega monster rally. So Hang Seng in Taiwan closed in the red. But other than that, the other Asian markets closed up in the green. And Europe today has started off mildly lower. So the CAC, DAX and the FTSE are in the red as we speak. So inflation data, the all-important US inflation data that comes out tomorrow, so maybe some caution ahead of that.
Absolutely. The Chinese markets turned around because some of the macroeconomic numbers that came out there on exports and imports, those were not looking too hot. And then the excitement around this looser monetary policy and unconventional stimulus measures, all of that excitement kind of fizzled away, because it's been 24 hours since we got that announcement. And that was a final close coming in some of the regional markets. Okay, here for us, let's focus on what's working. One pocket of the market that's alive and kicking is this entire capital markets space, companies that are related to the capital markets. And the reason is that today Motilal Oswal initiated coverage, not initiated coverage, actually it came out with a report. Some of the stocks are already under its coverage, and on some it sort of gave out fresh views. And many of those stocks have reacted very well to some of that commentary. Nippon Life India, for instance, 8% higher. Nuvama is 6% higher. We'll tell you more about these stocks and exactly what is the what is the thesis that Motilal is talking about. So that's one theme in the market that's worked well. For the large caps, the saving grace is that tech names are still trying to fight for the bulls. So you've got Wipro, HCL Tech, Infosys. There's still some green on the tech side of the screen. Other than that, not much to speak of in terms of the gainers. Some of the non-banks like Shriram Finance, Bajaj Finance and Finserv, they're having a good run as well on the green side for the Nifty. So you have some of these NBFCs and you have some tech names, and that's where the gains are. Nigel, how's it looking last 1 hour?
Well, that's right. Interesting times. A bit of red on the screen. Third straight session that we could possibly end in the red. So we'll have to see how things go. But let's get in Mitesh Thakkar to help us out with a couple of closing strategies. Hi, Mitesh. Good afternoon. Good to see you, Ben. What's the trade on the Nifty first?
Nigel, on the Nifty in the morning also I commented, I think, we are looking at possibly a range scenario. Therefore, buying should be done closer to about 24,500. And I think now we're not far away from that, about 25, 30 points. So around those levels, once we see some kind of a reversal, I think longs can be taken and keep a 50, 60 point kind of a stop. I believe that 24,500, 800 is the broader range which the Nifty is falling, and therefore, from 500 odd levels, 24,500 odd level, you would expect some kind of a bounce back to about 24,750, 800 zones again. So maintaining a long bias, but waiting for the trade to be triggered. On the stock side, I have a buy on Hoodco. Buy here with a stop at about 247 for targets of 265, and a sell on Marico, which I would recommend selling. With a stop at about 621 for targets of 590.
Thank you very much for that. Marico was up 5% yesterday. Down 5% yesterday. Today it's up close to about 0.5%. Moving on, Motilal Oswal in its recent report says the Indian capital market has seen a remarkable growth in the last 5 years. But the penetration still is fairly low. Vamakshi is here with the key highlights of this note. Vamakshi.
Well, that's right, Reema. This whole theme has seen a remarkable growth over the last couple of years. And, when we look at the overall theme, penetration, however, has been low. Case in point, when you look at the demat penetration, is at only 12% as compared to 62% for the USA. MFAUM to GDP ratio too is quite low at 17% as compared to the global average of around 65%. But not just that, in terms of headroom, there's several other opportunities as well. Over the next decade, demographic dividend is expected to accelerate. Apart from that, UPI and eKYC have already revolutionized, the brokerage as well as the MF industry, and is expected to likely drive growth going forward as well. Account aggregation is too likely to transform personal finance industry and in turn, drive digitization in wealth management, broking, and several other segments. Yes, the regulations have been tightened of late, but this has been done largely to strengthen the overall ecosystem. The recent F&O regulations that too came through are expected to hurt the volumes only in the near-term basis, but once the base is reset out here, the growth is expected to pick up. Now, largely given all of these factors, sustainable revenue growth of anywhere between 17 to 45% CAGR can be expected over the next 3 years, that is from FY24 to 27. And over the same period, given that operational leverage will kick in, superior profitability could also be expected anywhere between 12 to 75% CAGR. Now, they've also highlighted their preferred picks among the overall capital market theme. Among AMCs, they like HDFC AMC as well as Nippon. They have a buy rating on both of these counters. For HDFC AMC, the target price is at 5,200, while for Nippon, it's at 900 rupees per share. In the broking space, they like Angel One. They have a buy rating out here, target price of 4,200. Among exchanges, they like PSC. They have a buy rating, target price of 6,500. Wealth managers, they prefer Novama as well as 361 BAM. They have a buy rating on both of these counters. And as far as the intermediaries is concerned, they prefer CAMS. They reiterated their buy rating out here, target price of 6,000 rupees per share.
Thank you very much for that. Golden era is what they call it for the Indian capital market ecosystem. Deepak Shenoy, part of that, founder at Capital Mind, is now with us on the show. Deepak, thank you very much for joining in. The opportunity is there, growth visibility is there, but stocks have already run up. Valuation is on the higher side. Do you still like it? Can someone go out there and buy today if they have a 3 to 5 year time horizon and your preferred pick?
Oh, that's an interesting set of questions, Reema. I'll answer the first part. I think the capital markets in general, whether it's debt or equity, relatively under-penetrated from an Indian household perspective. Therefore, we're seeing a lot more activity. We've seen 35,000 crores come into mutual funds in November. Despite a tepid October and November, we've had fairly strong inflows into equity funds. Very diversified portfolio approach. We've got flexi cap funds, mid cap funds, large cap funds, all of them getting reasonable amounts of money. So it's a very, I think India is finally waking up to its equity market potential, and effectively FIIs are becoming, foreign investors are becoming a smaller portion of the non-promoter stake of Indian companies compared to domestic investors, either directly or through mutual funds. But I think that is that's going to be much higher growing phase. We are only about 20% of Indian GDPs in mutual funds, 64 lakh crores. I think that should probably increase to 30 or 40% in the next decade. So we'll see a lot more domestic participation. Therefore, almost a lot of the financial infrastructure players are likely to do well, whether it is people like us who are asset managers or whether it is exchanges and depositories and RTA agents for mutual funds. I think all of them will do well, including the areas around insurance and some of the other players. I feel, given the markets, there are always going to be pockets of overvaluation and pockets of undervaluation. Strangely, for the most of the past decade, private sector banks have been overvalued. But today, in comparison with the rest of the market and perhaps their own history, they're not as richly valued in comparison. So you might find that they are more attractive from a valuation perspective than many of the other players out there. A lot of others, including some of the PSU players, I think haven't realized their full potential yet. So there is still scope for a 3 to 5 year position in many of them. Now we own some of these stocks, so I won't say I'm unbiased, but I think domestic stories also, including domestic consumption, defense, infrastructure, and domestic manufacturing, all of these plays should do really well in the next 3 to 5 years, mostly because the world is getting more insular and trade is no longer the primary concern. People are more looking at making things themselves in their own countries. If India were to adopt the same approach, we would massively reduce our imports simply because we can manufacture more here. I think consuming and manufacturing here is going to be the story of the next decade. So players there, whether it is an engineering company or a domestic consumption brand, I think all of them will do, many of them will do really well in the next decade.
Okay, yep. And those stocks have been reflecting a lot of that enthusiasm as well over the past many months now. Deepak, got that. So that's obviously the capital market space. Deepak, by the way, Wari Energy, any thoughts? What a listing. I mean, and it's been a little choppy, but there's a lot of interest around, obviously, the stock and the sector.
Yes, I think a little bit about it. We don't have a position there. It's too early, I think, for us. But we'll wait for two things. Firstly, what happens with this whole America's change in stance around renewables, which might change the demand worldwide for someone like Wari. Of course, I don't know if this will meaningfully affect their financials. I don't also see this as a major challenge in the long term, but it could be that if America steps away and changes its stance on how it perceives rewards for companies that are doing more solar, we might see a change in the demand and supply equation for many of these companies, not just Wari, but also wind players and so on. And I think it will come at the expense. I mean, on the other side will be nuclear, which is not traditionally known to be a renewable resource, but it's actually a very rich resource for energy. So that might actually do well regardless of what happens. So I feel that beyond that, I don't have any visibility. I think we'll wait for 2 quarters of results after listing before we generally take a position. It tends to give us a little bit more understanding of how good the governance is in the organization, and also about more granular understanding of the demand and the growth potential in the marketplace.
Okay, all right. Deepak, I wanted to ask you about Greaves Cotton. They announced a few days ago that they're going to be demerging and listing the EV part of their business separately, the electric mobility. And that business is a loss-making business, but we know it has tremendous potential. And these businesses are normally valued on sales. Though at the half-year mark, I see there's a degrowth in their total sales volumes. Last few months have been better. What's your view on it? It was at around 180, 190 rupees when that announcement came. Currently, it's around 250 rupees. We know Mr. Kedia has gone ahead and bought a chunk in it. Have you done any work with regard to the sum of the parts? Because the X of the mobility business, actually, they're making profitability.
Yes. In fact, Nigel, I think that is the interesting part of the business where they've been able to maintain a decent hold on a business, on the engines business before they went into this Ampere part of the equation, which is the EV part. But the EV part has to scale. There are lots of challengers here, including Ola, which is also listed, but also TVS and a few other players that are getting their act together. We haven't even seen a meaningful move into this market in general in terms of market share. But I think this should become a 20-25% market share of just EV players in overall sales in the next few years. Not because EV is environmentally great and all that, it's just that the lower cost of operation might actually start to benefit people a lot more. Much about this having been said, I think Greaves will have to demonstrate its ability to retain or grow market share. They haven't been able to do that in the last few years, and perhaps the fundraising might give us an idea eventually once they demerge, if they were able to raise more funds, to be able to demonstrate to us how they will be able to grow this in a way that they can compete with some of those relatively deeper pocketed players who have even more profitable, other than Ola, the TVS and all of them have very profitable core businesses in their ICE two-wheeler space. So there is a lot more ability to spend and ability to distribute over there. So I believe here that valuations will have to be, not based on profitability. Perhaps even the number as a multiple of sales will be very high to begin with. But I would wait for that business to list and then buy that business separately. The current business is not, that great from a perspective of growth. I think it's more B2B in nature, but I would value it at a very high multiple there. But I think based on what Greaves' plans are for the electric division, you might actually give it a much better valuation based on how they plan to do growth. The demerger is the best way to unlock value, to be honest, and I think more companies should do that going forward.
No, such a sharp move, right? And it's come so hard. The other one, which people have been waiting for I think at least 1.5 years, if not more, and there are people who've owned that stock, waiting and waiting and waiting, and now things seem to be moving. But let's just hope it's not one step forward and two step back. I'm talking about Religare. Stock's up. It's off the highs. Now, the news is that the RBI has approved the Burman family plan to acquire the 26% stake in the company. Open offer. Vivek is here with details about what this means and what are the next steps. Vivek.
Well, that's right. 1.5 to almost 2 years now, as far as the sparring is concerned between the Burman family, that intends to go ahead and take controlling stake in Religare, and the existing board helmed by Dr. Rashmi Chaluja. Now, what's actually happened today? What is the fresh piece of information? Today, the company or the board has received the approval from the RBI. Basically, RBI has given its nod for the Burman family to go ahead and take ahead the open offer. So that is one important tick mark in the process of the Burman family going ahead and announcing, as well as completing all the formalities for announcing and taking over 26% stake as far as Religare is concerned. Now, RBI has two caveats that is mentioned in its letter. Number one, the acquirers, that is the Burman family, need to consolidate all of the NBFCs in the resulting structure before March 31st, 2026. And also, there was a request to go ahead and appoint 4 proposed directors. At this point of time, RBI has not given a nod to appoint those 4 directors. Now, as far as the open offer is concerned, remember, there were approvals required from CCI, which the company has received, from the RBI, which has been received today. SEBI, was awaiting the RBI nod to come, so that too should come. And also, the IRDAI nod was expected, given the fact that the company does have care insurance. So IRDAI nod too is in the favor as far as the Burman family is concerned. So now, next step, the key to track will be the AGM, that is on 31st December 2024. The reappointment of Dr. Rashmi Chaluja as a director in the company will be up for voting, and it will be very important to note as well as take note as what will be the outcome of that particular note. Remember, September 2023 is when the Burman family had gone ahead and announced an open offer at 235 rupees a share to acquire up to 26% stake in the company.
All right, Vivek, thank you very much for that. Deepak, again, I don't know if you own this, but I know lots of people who own it and who waited and have been not been rewarded, not yet. Although it's come up from the offer price at least, closer to 300 rupee levels now. Any thoughts?
No, we actually don't own much, Prashant. I don't own any of this share. It's been a bit of a soap opera, this whole business, for the last 4 or 5 years. And generally, soap opera plays don't work out very well for me from an investment standpoint. Never understand when these turning points come and some court order, something else seems to happen all the time. So not worthwhile when there are other opportunities out there. I think I'll just wait for this whole drama to get over and then maybe take a stance. And once you have a more pakka open offer, if this whole thing actually pans out now, once SEBI gives their approval, then there may be a small short-term opportunity in the share. But I would like to see it after this takeover is complete, how the financials and business actually moves, especially because they may have to integrate some of the other companies into it, and those financials need to be integrated at some level and so on. So I will have to figure out how this whole thing works. I'd wait for the whole thing to die down. But I mean, it's a lot of entertainment value, so not denying any of that.
All right, that's nicely put, Deepak. And maybe some good will come out of it as well, right? I mean, after all of the soap opera viewing. Thank you very much for joining us. Good speaking with you, and thank you for being here this Tuesday. We slip into a break, but let's introduce Growth Code. I mean, this is a special initiative by Grow and CNBC-TV18 with the aim of empowering investors and traders, prominent investors and professional traders. Gather at Grow's Trading Right Summit on November 9th to share their valuable insights and strategies. Here's A's investor, Ramdev Agarwal, chairman of the Motilal Oswal Group, and what he had to say about stocks an investor should hold in their portfolio for optimal diversification. Listen in.
For an individual investor, you should have as many stocks as many you understand. If you have knowledge of 10, 15 stocks, have all of them. Or if you have the knowledge of only 5, 6 you don't know, you're fine with 5. As far as the statistical theory is concerned, after 15 it doesn't matter how many you have. Because all the benefit of diversification gets completed the moment you hit the 15 individual stocks. So, but then if you want to be very aggressive, if you are very young, you are very confident, you know the company, what you're buying, you know the price and value gap, you are pretty comfortable buying 5, 6 stocks. Have 20% in 5 stocks.
Okay, welcome back. We have the market, which is down about 60 points, 24,556 at this point in time. The general insurance numbers for the industry is flashing at the bottom of the screen. This is company-wise, ICICI Lombard. And I think everywhere seems to be a bit of a drag. Look at go-digit premiums and a bunch of others as well. And, growth rates have fallen quite a bit. And what we're putting out is growth rates for the month of November as compared to what we saw in November 2023. Star Health up on your screen. So sharp deceleration is what we're seeing. So we'll have Yash join us a little later to put this in a perspective. N. Jayakumar is with us, Group CEO and Managing Director at Prime Securities. Jayakumar, good to have you with us here. Good afternoon. Thank you for your time.
Good afternoon.
So we're wrapping up 2024, Jakes. We're looking into 25. So give us ideas how to make money in 25, the big money-making ideas as you look into the next year.
Well, I'm not sure about big or small. I mean, that time will tell us. But essentially, I think the markets have done extremely well in terms of a correction in the way that it's played out over the last 2-3 months. And I think it's shaken out a lot of people. It's shaken off some of the really sort of hardened veterans, if you will, to believing that we've made a top and now, this is going to be a top for some length of time, etc. So a lot of people got shaken up, and I think public in general has been quite skittish. All of this, which has essentially convinced me that around the 200-day moving average, we made a very strong bottom. And given the way the markets bounced off that, covered virtually 50% of the losses from the 26,000 plus levels that it had visited. My own sense is that we could be looking at new highs as early as second, third week January. I think a lot has played out. We are seeing, interest rates to the extent that they will get cut maybe a month, 2 months down the line. I think maybe the change of guard at the central bank could mean that interest rate cuts may be more forthcoming than otherwise. The increase in or the reduction in CRR would help with liquidity. I think that will have its pervading impact in the economy. And the government spending, which has been so far a bit of an issue. We've had the lowest government spending in approximately, 13 years. That, to my mind, will gather pace quite dramatically. So all in all, I'm quite optimistic, and it wouldn't surprise me to see a new high second, third week January as I sort of crystal ball into the next few weeks.
Jakes, hi, afternoon. Rima here. Are you still bullish on PSU banks, or do you think, the stupendous rally that we've seen over the last 2 years is now all the good news is in the price, perhaps, and from here on, it may not be the kind of outperformer as it was?
More bullish right now on private sector banks, especially those that have got, beaten down on one pretext or the other, notably this MFI. Now, it's interesting to note that some of the MFI banks in general are quoting at 2 times book, while some of the private sector banks, which have been, in a sense, which have between 7, 8, 9% of their exposure in the MFI space, they have got hit in some cases to below book and in other cases to close to book. So private sector bank valuations, I think, will catch up. I think that's where the reversion to mean will happen. And the principal reason that guides me to this kind of thinking is that we have probably, as I mentioned in the earlier question, that fair amount of government spending left to be done for the end of the year. And when that sort of moves into the economy and there is velocity of money in the rural space, the MFI stress will come off, and especially banks that have been inordinately beaten down as a result of this MFI exposure or credit card exposure could actually face a fair amount of springback. And I think it's, in a country like India with banking licenses now being almost, no new licenses to be given, and we have only a finite number of banks, the disparity in valuation sometimes that gets set in as a result of 1 or 2 factors that could be seasonal or transient. That gives you the opportunity to buy into. So I think private sector banks for me are far more attractive as a group, and I don't want to talk specific stocks. than public sector banks for the moment.
Okay, hi Jakes, good afternoon and good to see you in. I'll ask you about metals in a bit, but what about FMCG? Godrej Consumer out of nowhere, they have come ahead of the end of the quarter and warned that things are not as rosy as it seemed. And HUL as well as Colgate in their investor calls as well, they stopped short of saying that there is a recovery underway. What's your view on these FMCG names? Because the index is closer to the highs, but you have some of these frontline names that are down 20, 25, 30%.
And for good reason. Their growth has been limited, valuation multiples have been excessive, and a lot of, in a sense, the FMCG space exposure has come through the new age companies. I haven't been, in all fairness, a great, for the last several interviews of yours over the last maybe 3-4 years, not been a great fan of the FMCG space. I've been happy, to miss it as 60p stocks move to 80p stocks with 5% growth rates. And if that kind of thing prevails, clearly at some point in time, the cookie had to crumble, the chicken had to come home to roost, as it were. So I think they have come, these could go through long periods of consolidation. People are reluctant selling these companies. The inorganic growth is not there, organic growth is limited, pricing pressures are there, and the new age companies are willing to burn money in order to gain market share, and they're also burning capital in order to bring down prices. So I can't see either pricing power or, in any case, consumption as a theme was limited. So for me, the FMCG is happy avoid, and I'll continue to be there. If I have to play that space, it'll be through some of the new age companies, and that's probably the way to do it as well.
Yeah, the new age companies, they've been definitely catching the market's attention, right? With the Zomato and then now Swiggy making waves. Jakes, great to have you on this afternoon. Good chat as always. I just want to go to pharma, which is a space that you've liked for a while. And it's in the headlines for not so great reasons right now. I mean, at least this week, it's been all about the US Biosecure Act and whether it'll get passed and whether the legal legislation sort of moves forward or not. So there's been some worry around it. Your thoughts on whether it is the CDMO space that you're more optimistic on, and what happens if indeed this Biosecure Act doesn't go as per plan, which means that it's not advantage India over China?
No, I don't think you can conclude that. It may not be advantage India over China in a short tactical, should I say, CDMO space. But I think what can't be taken away is the fact that the generics pharma space is continuing to do extremely well. The generics pharma space is offering substantially lower prices for the same products, which I think anybody in the sort of helm in the US will go for. So I don't think that has changed. There have been some pockets which they have said has some pricing pressures where there are more than one player. But in general, I think that's a secular theme that will continue. So in the pharma space, I kind of like some of the PLI players, who are manufacturing here as import substitution kicks in, and the generic space. And where there's a combination of both these, I think it offers a great opportunity to buy into. Some of these stocks have come off from their recent highs, and therefore I think they offer margin of safety as well. And there are still stocks in the space going at sub 12 to 13 EV/EBITDA multiples, and I think that's fair for companies that are in the which are producing over 5,000 to 6,000 crores of EBITDA, and there are companies producing even higher than that, going at best low double-digit EBITDA multiples, and I think they offer great opportunity. The risk is where people get carried away in a theme like the CDMO theme and buy into assuming growth over the next several years when the production itself has not begun or kicked in. That's where the risk is. And wherever there is euphoria, I mean, we've seen this is not just banking, not just pharma, but corrections happen pretty brutally when people are well committed. So given that, my own sort of sense is there are still pockets in the pharma space that offer a lot of value. 1, 2, 3 companies I can talk about, which are not on the channel, but which we as a house or me as an individual keep track of as opportunities to buy into.
Okay, all right, got that. Well, thanks a lot, Jakes, for joining in, giving us your view on all those sectors that we discussed, from banks to FMCG to the pharma pack as well. Wishing you a good rest of the day. And in fact, if we don't speak in 2024. Looking forward to chatting with you in 2025 as well. But it's that time of the day where we have Nimesh who's joining in on D Street Chatter to help us out with what he's picking up. Well, Nimesh, another down day, but it's only up and away for you from here on. Happy birthday, Nimesh. Wishing you all the best. You know, it's been great working with you. Absolutely. And I'll tell you what, more than me, all the viewers love it because you're going to give them some insights which no one else can give them.
I mean, that's the part of the job, right? You do what you do best in terms of quizzing the management. I do best in terms of getting the chatter. So again, thank you very much for the wishes, Nigel. Thank you everybody in the team as well. From a market perspective, Nigel, you know, I think it's another day of consolidation, but the flow seems to be a bit tepid today. So the activity seems to be on a lower side in today's market. And having said that, the flows are slightly towards the sell side today. That's the overall indication. Okay. Having said that, there is a bit of buying in financials and consumer discretionary from the larger institutions. So that's the overall flow that I can pick up. But the good part is that the broader market seems to be outperforming on a daily basis. Even today, it's recovered from the lows and it's in the green now. I guess one reason for that outperformance is the fact that the inflows in the domestic mutual funds seems to be largely in the mid and small cap funds, right? And that explains that in the last 1 month, the mid and small cap have relatively outperformed. And it looks like that outperformance may just continue back on the domestic flows. From a technical point of view, I think 24,300, 24,350 is an important level on the downside to watch out from a support point of view. So need to see whether we support on those levels. But broadly, I guess today is a day when the flows are a bit tepid. But again, the mid-cap and small-cap outperformance continue.
Well, that's right. And that's what makes portfolios as well feel good. And, you know, Nimesh, as you were doing that piece with regard to telling us, the markets actually have recovered from the lows of the day. So that's good news. But let's focus on individual stocks. What are you picking up?
So, you know, as I said, you know, there is a lot of action in the broader market stocks. So most of the chatter today is part of the broader market stocks. The first name is Kansai and Narrow. While the stock is down in today's trade, down 4%. But in general, the stock has been consolidating in a narrow range. But now I understand there could be a large block deal in Kansai very soon. The shareholding is quite tight, right? The promoter owns 75, and there are a few institutions who own 6-7%. So looks like a large block is coming in Kansai and Arulai. The second name is SPML Infra. We don't normally talk about that stock, but that's been buzzing on good volumes as well. I understand there is some H&I activity as well. And the buzz is that the company is likely to bag a large order very soon. Remember what happened to Carnex Micro as well. A small company bagged a very large order and we saw a big reaction. I guess similar kind of large order can expect in SPML Infra as well. So that's the second name. The third stock is Shiva Moto. Again, a small stock. We don't talk too much, but big volumes on that name. The stock is up 15% last when I checked. Again, maybe the reaction is in anticipation of a fundraising via preferential issue very soon in Shiva Moto. And the last is CG Power. You know, at record levels, stock has seen a bit of a consolidation in the last few months, but now I understand the company is very close to raising funds via QIP, and large part of the fund will be used for some organic opportunities. That's the buzz on CG Power.
Okay, well, Nimesh, thank you very much for that. So, two new names, SPML Infra and Shivam Auto. Not new, but names we don't discuss very often. And of course, I mean, the other ones are interesting as well. CG Power, so fundraise finally coming through. They've done a couple of acquisitions, but this, as Nimesh said, for CG Power is going to be used towards organic organic activity. So we'll see and keep track of some of this. Let's listen to veteran investor and chairman of Motilal Oswal Financial Services, Ramdev Agarwal. So we spoke with him earlier today. I mean, the theme of this year's wealth creation study is rooting for bruised blue chips. These are blue chips, essentially, self-explanatory, which have taken a large dip because of XYZ reason. Ramdev, you spoke about this in that interaction. Listen in.
Nifty, any Nifty inclusion is also blue chip. So first 50 is the whatever Nifty companies, and then on top of it, any company which has more than 20% average ROE for 10 years. Very stringent not, I can tell you this.
Correct.
So we came across about 107 companies in total. Actually, in Nifty, about 20 companies, 22 companies are blue chips. So it is very tough to beat Nifty in the longer run because they're all blue chips. You know, from that 300 rupees, see, in buying blue chip, the fun is that blue chips do come back to their old high. See, there is a consumer slowdown for sure. Okay, I mean, I don't know why nobody's painting the houses, but there is a slowdown in the consumption of paints somehow, and in that, then your builders they want to create a niche for themselves. They have put up 10,000 crores plant, 4-5 plants they've already started. So there is a massive push to garner market shares. In fact, in where there is a very intense competitive war, typically the industry profitability takes a dip significantly, or it goes to the level of literally zero profit. 2-3 Adani companies are there in the list. They have been bruised quite deeply, some of them 70-80%. Then you have Asian Paint, then even our dear Avenue Supermart is down about 30-35%. Then because there is again massive competition coming from Zepto, Blinkit and Zomato.
Welcome back. Well, keep your eye on a couple of stocks. Sambandana Motherson, I think, should come up for you on the screen. The stock has recovered a little bit from the low point of the day. It's still 20% off the recent peak. But as we speak, the volumes are fairly decent over there, and it's above the 20 DMA. Just moved above the 20 DMA. So Sambandana Motherson is one stock that we're tracking. And the other one is Senco Gold. The stock from the day's low has seen a good recovery. Yesterday as well, it went to a high of around 1,180, and from there, it did see some selling. But today as well, it's moved a little bit higher in the last hour or so. Mitesh Thakkar is back with us. Mitesh, the headline index has seen a good recovery, but give us some individual trading ideas.
So I have a BTST. I think, emphasis on the entire IT pack is still looking better than the rest. So emphasis is a BTST. Disclaimer, we have some options positions over here. So there's vested interest. But this I would recommend a BTST with a stop at 31.69 for targets of 32.20. And the other one which I like is Godrej Properties, which could show good traction on the intraday and the daily charts. So BTST here with the stop at 2794 for targets of 2840.
Okay, let's get to the insurance numbers then. The general insurance industry has seen a sharp drop in the premiums in the month of November. Yash is here with the numbers. Yash.
Well, Rima, the industry was doing pretty well till like the last month as far as premium collection is concerned. But in the month of November, there's a sharp drop, as you pointed out, which has been seen in the premium collection numbers. For the entire industry, November premium collection has grown just by about 4%. For the first 8 months, the premium collection has grown at about 9%. The industry was growing anywhere between 15 to 18%. And we've seen a slide of about 4% growth in the month of November. Standalone health insurance industry has grown at 10%. First 8 months, the premium collection has been up 21%. This side of the industry, that is standalone health insurance, was growing at about 25 to 28%. The slides come all the way down to about 10% growth. ICICI Lombard, after a very long time, there's been a degrowth in the premium collection in the month of November. The premium has contracted by 3% in the month of November. For the first 8 months, it's up 12%, and there's a 22 basis points market share gain also. For ICICI Lombard also, the growth has been good in this year so far, about 15 to 18%. Now, in the month of November, there's a contraction of about 3%. New India Assurance, November premium has grown just by about 6%. First 8 months growing at 3%. And there's a 71 basis points market share compression for New India in FY25. Go Digit General Insurance, again, a contraction in the month of November by about 4%. First 8 months, the premium is still up about 9%. And there is an increase of 1 basis point as far as market share is concerned. Speaking about the two standalone health insurance companies, Star Health, the premium collection in the month of November is up 8%. This growth was about 18%, and now it's come down all the way to about 8%. First 8 months, the growth is 14%. Niva Bupa Health Insurance, the November premium growth stands at 15%. This was somewhere about 30 to 35% in the recent past, now coming down all the way to about 15%. And first 8 months for Niva Bupa, the premium growth stands at 26%.
Okay. All right, Yash, thanks very much for that. So that's all the insurance data on the radar. Okay, that's PNB. The PMLA court is allowing monetization of Mehul Choksi's properties. That's a large amount that PNB then could get once it's allowed to monetize some of those properties that it would have seized as part of that scam which took place a couple of years ago now. And the stock's moving higher because of the prospects of maybe getting up to 2,500 crores from the monetization of those assets. So that's PNB making headlines this afternoon as well. Speaking of financials, there's one more stock that's on the radar, Bajaj Finance. Abhishek is joining in. The company, I think, met a couple of analysts today. There was a conference call of sorts. Abhishek, tell us more.
Well, there is an ongoing analyst meet that Bajaj Finance is holding for analysts or buy-side community at large. So they have given the long-range strategy over there, wherein they say that customer franchise will increase from 9.2% in FY25 to about 19 to 20 crore by FY29. They see a huge jump in FY29 versus FY28, given the fact that they have also mentioned that there will be some acquisition which will boost the customer base over there. Cross-sell franchise will increase from 5.8 crore in H1 FY25 to about 11.5 to 12.5 crore by FY29. Now, India Payments GMV, that is 0.27 at H1 FY25, that margin will improve to about 1.25 to 1.5% in FY28, but it will fall down to about 0.4 to 0.5 in FY29. So, share of total credit will increase from 2.1% in H1 FY25 to about 3.2% to 3.5% by FY29. Retail credit, that will increase from 2.7% and H1 FY25 to about 3.8 to 4.2% by FY29. They also expect an improvement in the return on equity, which is at 19.4% in H1 FY25 to a range of 20 to 22% by FY28 and 29. So AM per per cross-sell will improve from 64,800 that they had in H1 FY25 to about 80,000 to 85,000 by FY29, but it will be on a higher range in FY28 at about 90 to 95,000. Bajaj Finance over there, the consolidated income that is being targeted is about rupees 3 lakh crore in FY29 versus rupees 1.1 lakh crore in FY24. So they are expecting a CAGR of 22% over the next few fiscal. They are targeting a PAT of 20,000 crore by FY29 versus 8,000 crore that they had in FY24, which is a CAGR of 18% to 22% over the next few fiscal. With reference to the life insurance, they say that they'll continue to gain market share with top line growth being at 2x of the industry level, and they also want to increase their contribution to 10% of RWRP, which is retail weighted received premium, from 4% that they have in FY24. So in terms of product mix also for the life insurance, they are planning to change it to about protection being 10%, non-participation being at 25%, participation at 30% and ULIP at 35%, from currently traditional to ULIP being at 61 to 39 ratio. So return on embedded value is targeted at 18% to 20% in the near term or in the coming future versus 15% that they have in FY24. And VNB growth, they are targeting that to be faster than the retail weighted received premium that they are targeting going ahead. Back to you.
That's an ocean of numbers, Abhishek. Tell me this, Abhishek. So with what you've seen, are we likely to see any change in ratings, upgrades, anything tomorrow morning?
Seems like growth rate might come down. Now they have been growing north of 25 to 30%. That growth rate might come down to anywhere between 20 to 25% CAGR that they are targeting. However, the return on equity improvement that they are targeting should augur well for the company.
Okay. Growth rate should come down compared to what they've already done or compared to what the street is expecting?
That estimate is not there by the street for FY28-29.
Okay, all the way to 2029. Thank you very much, Abhishek. Appreciate it. We'll take a quick commercial break here. We're going to come back and, we'll speak with Jay Bala. He's, of course, with Catch the Chaos, and we'll talk technicals and specific trades. Stay tuned.
Welcome back. Now it's unchanged on the Nifty. 0-point move on the Nifty as we speak. Sensex is just up close to about 30 points. Few minutes to go as we wrap up today's trade. There has been a bit of a pickup in the markets. We were down 20-odd points. Now we're flat. Jay Bala of cashthekiosk.com is now joining us on the show. Jay, last 2 days, things have been very, very sideways for our markets. What have you made of the action and any trends that you can spot towards the end of this calendar year?
Hi, Rima. Good to be here. See, the market is doing something more important. Monday it broke the Friday's low. Today it broke Monday's low. So the market is signaling weakness, although the market is flatlining today. As I pointed out last week, I said the bears would be better off if they conceded some ground and let the market climb to somewhere close to 23,800 or even 25,100. The market has come to 24,857 and is starting to look weak. One more high would be okay, but even close to 25,100, that would make the market structure look like it's turning positive, but it's not. It's just a counter trend rally. But what would convince me that the downturn has resumed is a break of 24,295. Until 24,295 is taken out on an intraday basis, I would assume the market is still correcting upwards. Wait for the confirmation to come through below 24,295.
Okay, all right. Hi, Jay. Good afternoon. Sounding cautious as we've heard in the last few weeks on the markets. So we take that point on the index. But today, you're going to give us two calls. And I believe one of them is the long call. So go for that first and then give us your short call. I think it's in Grasim.
Yeah, the September high for PI Industries, that's looking like an incomplete move for the stock. And the decline from the September high to the December low is an overlapping move. So that's possibly a corrective structure. But because the overall opinion of mine is, slightly cautious, I want to be sure that this stock is turning. So I'll wait for the stock to cross above 41.78, and then that will trigger a long for me. A very strict stop loss at 40.30 is important, and anticipating the stock to climb to fresh 52-week highs past 5,000 mark. And the short call I have is from the Adani Group. Grasim is looking like a corrective decline is still due. The recent high of about 27.34 is unlikely to be not taken out. So stop loss are above that level of 27.34 with a price objective of 2,400. Even Adani Ports is looking like the recent low it clocked in November. That looked like an incomplete move. So probably some moves are happening in the Adani Group. So if today's low gets taken out tomorrow, probably that will be a convincing move that Grasim is moving towards 2,400.
IT is up 5% since the beginning of December, and that's the only index, according to you, that hasn't broken important supports.
That's right, Rima. See, the markets are, for the IT index, it's moving from the November low in an overlapping fashion, but that's a five-step move. A five-step move is usually a trending move for technicians like us, but it's an overlapping move. But that's signaling that although the IT index is clocking fresh 52-week highs or fresh all-time highs, this is probably an ending move for the index. But as long as the index stays about 39,900, the sector remains bullish. So maintain bullishness, but with tight stop loss. The frontline Infosys and TCS, they are weaker than the broader names like Coforge or Persistent.
Okay, all right. I think, Jay, stay with us. We're going to just wrap out things here on the program. But those are interesting views from Jay, as always, in terms of specific trades as well. So there were two calls. One is short Grasim from Jay, and the other one was long PI Industries, which Jay has put out. Of course, apart from Nifty levels, and for Nifty, of course, Jay believes 24,295. That swing low is important, and if you start to trade below it, I mean, that would mean that the market has resumed its decline, and a few other sectors as well. I think that's the closing bell which has gone off, and much better, by the way. We end with nothing. Actually, we end slightly higher, maybe even, right? I mean, 1.5 odd points. The adjusted close will come up on your screen in just a bit. The Nifty Bank perhaps also should come up. And here also, actually, about 1/3% gain, which came through after a very sharp bounce from about 150. 150 or so was the low for the Nifty Bank. And from there, the Nifty Bank also posted a smart recovery. The mid-cap and small-cap indices end flattish, about 1/4% higher. So both about 1/4% in the green. market breadth did actually also recover quite nicely into close, and I think we were almost at about 1:1 as far as NSE advanced decline goes. Lots of movers. Shriram Finance, Wipro, Bajaj Finserv were some of the gains coming through on the Nifty. Losses coming through in names like Bharti, HDFC Life and Adani Ports. And of course, I mean, in the broader space, a lot happening. So LIC was a loser. And of course, in many cases, it was just reversals from yesterday. CET, Mapma India, HEG, Signity, MTNL, these were all sharply higher yesterday and they're all sharply down today. So just, I mean, you know, day on day kind of reversals is what we saw. A theme which did well, of course, was capital market companies. So Nippon India, Novama, 361, all these names were higher. And Gokuldas maybe deserves a mention as well. Gokuldas Exports with almost 1100 after taking out $1,000 yesterday. Well, it's a wrap on the session and closing bell. Markets forward. We'll pick up on all the action on the other side.